Biden's plan hurts high-income earners. In this episode, I'm going to address Biden's major changes to your 401k. So get ready. I'm going to explain what changes are in the works and what you should be doing. Hi, I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 4.5 decades. And so I keep very close to a lot of the legislation, things that are in the works based upon Congress. And sometimes, Congress is the opposite of progress, pro and con are opposite, And so I wanted to alert you about some of the things that are in the works under Biden's proposed plans with taxation. First of all, let's go through and address what a qualified plan is, traditional IRAs and 401ks versus the Roth IRAs and 401ks, before I share with you what he's proposing to change. These are very important concepts that you as an American taxpayer need to understand. And so as we proceed, I'm going to share with you some concepts that maybe you didn't even understand before as it relates to traditional IRAs and 401ks versus Roths. So in a nutshell, the traditional IRA and 401k type of a plan, and this would include 457s, 403bs, tax-sheltered annuities, pensions, profit-sharing plans. These are qualified plans. Qualified with who? The government, Uncle Sam. Uncle Sam is your partner, okay? Now, when you put money into a traditional IRA or 401k, the original premise was, put in pre-tax dollars or you get a tax deduction for what you're contributing like a IRA. 401ks are funded with pre-tax dollars. And so you get a tax break on the seed money, the contribution money. I often use the metaphor of the farmer and the seed. In other words, if you were a farmer and you had the choice in the springtime when you bought your seed that you didn't have to pay tax on the price of the seed when you bought it, but you planted this seed, you irrigated, you cultivated, you worked hard all through the summer, and then in the fall, I'm talking about the fall of life, retirement, when you go to harvest your crops, now you agree to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. You get a tax break on the seed money, but you have to pay tax when you harvest the money. That sounded good years ago because they would say, you're going to be in a lower tax bracket, right? Well, that has not been true or axiomatic for more than 25, 30 years now. Most people who have a respectable retirement nest egg at retirement find themselves in as high or higher tax bracket as they were ever in during their earning years, even if they have less income. Why is that? The reason why people find themselves in as higher tax brackets is because they were sort of going down the highway of life, trying to achieve financial independence as the destination, and they had one foot on the gas pedal, but the other foot was on the brake pedal, so to speak. They were deferring to some future perceived unknown advantage, and simultaneously, they were killing their tax deductions. See, most Americans pay off their house. They don't have that deduction in retirement. They do not have children. If they move back home as adults, you can't deduct them anymore as dependents. You're not contributing money to IRAs and 401ks anymore, so you don't have that deduction. If you're a business owner, you don't have those deductions, and Congress keeps raising taxes. So many people find themselves paying back every dime they saved in tax during the first 2.5, 3 years of retirement that they saved over the 30 years on the seed money, the contribution money. And they do it again and again and again. So whose retirement were you planning, yours or Uncle Sam's? Well, a lot of people began to realize it would be far better to simply pay tax on the price of the seed and enjoy the harvest without tax. And so in 1997, when the government was hard up for tax revenue, they did this primarily for them, not for us. But Senator Roth said, I've got an idea. Smart people are realizing if they have a respectable retirement nest egg, they're savers, it's far better to pay tax on the seed money and enjoy the harvest without tax. And he wanted to trigger tax revenue. So he said, we'll name this after me, the Roth IRA, and then later Roth 401k. Now that's a step in the right direction, but there's still a lot of strings attached that I'll explain. But see, that way you pay tax on the seed money and you enjoy the harvest without tax. And if you think taxes in the future will likely be higher, which most people do, that's going to be far better than a traditional IRA and 401k. What that did is it triggered tax revenue back in 1997. When people rolled money over from a traditional IRA or 401k to a Roth, then they had to pay tax, and then they could accumulate the money tax-free from that point forward and access it tax-free. So Roths are a step in the right direction, but let me share with you the difference here next. So I'm going to simplify this. Let's say that we had a lump sum of $150,000 and we're earning 10%. 10% means your money will double every 7.2 years. This is called the rule of 72. You divide 10, the interest rate you're earning, into the number 72, and that tells you how fast your money will double. So let's say that you're earning 10%, your money doubles in about 7.5 years. So 150,000 doubles to 300,000. If that's pre-tax dollars, 150, and now you've tax deferred it, it's grown to 300,000. Now at 10% on $300,000 nest egg would be 30,000 a year. You withdraw the 30,000 a year of interest in retirement, and now you have to pay tax. Most Americans, between federal and state income tax, 41 out of 50 states has a state income tax, pay about a third in tax. What's a third of 30,000? 10,000. You're only netting 20,000 to buy gas, groceries, prescriptions, and golf green fees, right? Well, what if you did a Roth? Now, if you paid tax on the seed money, instead of 150,000 in a 33% bracket, you only have 100,000. Are you with me? 100,000 earning 10% doubles in 7.2 years, up to 200,000, and 10% of that is 20,000 a year tax-free. Did you figure out something there? It's exactly the same net, whether you put money in a traditional IRA or 401k or a Roth IRA or 401k, provided what? Taxes stay the same. But most Americans, when I ask audiences, how many of you think taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? A few hands go up. But when I say, how many think that taxes in the long run will be higher? And a sea of hands goes up. And I go, so why are you postponing and delaying, procrastinating tax to some future perceived unknown advantage? And then you withdraw your money when we all agree taxes will likely be higher. I can prove to you mathematically that if you chose a Roth and taxes go up, you will likely have 33 to 50% more net spendable income when taxes go up. So Roths were a step in the right direction. But my favorite vehicle is what many savvy CPAs and tax attorneys call the rich man's Roth. So let me share with you what Joe Biden wants to do. So President Biden, he's trying to raise a lot of tax revenue. And so he is proposing that they get rid of pre-tax contributions to plans like 401ks. Did you hear that? In other words, if you had a $100,000 annual income and you wanted to allocate $15,000 to go into a 401k where you worked, you only have to pay tax on $85,000 because you get to put in pre-tax contributions. What he wants to do is get rid of that. And so you will have to report the entire $100,000 of income on your tax return. But then he wants to give a credit, a tax credit. And so he would maybe land that around 26% is what it looks like. So you will get a credit of 26% of your income, $26,000, a credit against that. Now, that may be good if you are earning less money because 26%. If you're in a 33% bracket, that's not going to help you. If you're a high income earner, if you're single or a married couple filing a joint tax return, making 80, 100,000 or more a year, this is not going to help you. It's going to hurt you. This is only going to benefit low income earners that are in less than a 28% maybe federal bracket or 24% federal bracket, plus a lot of states have about another 7% on top of that. So if he goes this direction and you're a high income earner, this is going to hurt you as far as what you've been experiencing as far as tax benefits on traditional IRAs and 401ks. Now, if this is intriguing you, I would invite you to share it with someone who is also a little bit confused about what's going on and what's in the works, or comment or push like. But I would love for you to subscribe, and if you do, push the bell so that you can be notified. I post an in-depth answer to a financial question almost on a daily basis. So let me give you my advice on what I would recommend if you're a little bit higher income earner, a little bit higher than the average American. I would say, well, a Roth is going to be a better choice for you than a traditional IRA or 401k. But I've never owned an IRA or 401k. Never will. I've never owned a Roth IRA or 401k. I never will. Why? Because my favorite vehicle, which I call the Laser Fund, Laser is an acronym that stands for Liquid Asset Safely Earning Returns. It has the two benefits of a Roth and 4 additional benefits that Roths will never have. So why would I put money in a Roth when I can have 300% more benefits, 3 times the benefits that a Roth has? See, again, a Roth is going to be better on the back end if you have accumulated much of a retirement nest egg, if you're going to be in a higher bracket. The only time it made sense for people to choose traditional IRAs and 401ks is if they were not savers, if they didn't save very much. Now, what's the difference between a normal Roth and what CPAs and tax attorneys call the rich man's Roth? The Laser Fund, let me share with you the 6 advantages. So the Laser Fund is a vehicle that allows you to accumulate, access, and transfer your money totally tax-free. It's been grandfathered in the Internal Revenue Code for 107 years as of the recording of this video. And folks, it is like a tax-free sacred cash cow for people who are saving for retirement. So I have earned average rates of return of 8.2%, some years 10%, some years 25%, but I'm talking about average rates of return where every $1 million that I save can generate predictably about $80,000 to $100,000 a year of tax-free income if I live to be 120. Most IRAs and 401ks and Roths cannot do that. The 2 benefits of a Roth, you contribute the money with after-tax dollars, okay? It accumulates tax-free, and you can access it tax-free. Well, the Laser Fund has those 2 benefits, but it has 4 additional benefits. The next one, number 3, is that with the Laser Fund, I can put in a large lump sums. If I'm a business owner, let's say, and I have a banner year, I'm not restricted. See, Roths, you can only put in a certain dollar amount or a certain percent of your income. Do you know if you make too much money, you can't even participate in a Roth? So savvy CPAs and tax attorneys say, oh yeah, the Laser Fund that Doug Andrew talks about, that's called the rich man's Roth. And I snicker. You don't have to be rich to own one. You could put in $500 a month. But see, rich people can't even own a Roth. They make too much money. So let me give you an example. If I had a banner year, business was just crazy, I could put in $300,000 into a Laser Fund. You can't do that into a Roth. But I could have put in $300,000. I have $270,000 of room I didn't use. I can make up for that anytime I want. I don't have to use the room in that single year with a Roth. If you don't use the room in a given tax year, you lose it. Here's a big benefit. If I put in, let's say, $300,000, I don't have to put in that much, but if I did, 30 days later, if I had a business opportunity or investment opportunity, I can access $250,000 of that. There's no IRS penalties. If you touch a Roth, there's a penalty if you touch the money within 5 years or age 59 and a half. There's all those strings attached. I don't want those. The 5th benefit, you get to use indexing. Indexing is a strategy you ought to search on this channel. This allows me on my retirement nest egg to be able to participate when the market goes up, the economy is going up. But when the market goes down, I don't lose because my money is not in the market. It's not at risk in the market, but I get my returns that are linked to whatever the market does. And the 6th and final benefit of the Laser Fund, when you die, it blossoms in value and transfers totally tax-free. Now, you can learn about this in a book I'm going to gift you here in a moment. But I'm 68. If I died next week in an accident, every $1 million that I would have, let's say, in a portfolio of Laser Funds would blossom immediately to about $2.5 million, tax-free and transferred to my wife, my kids, my grandkids, a church, a charity, whoever I want. People say, wow, how much does that cost? I go, well, nothing's free, but It doesn't cost me anything. It's coming along for the ride. It's being paid for automatically with a minuscule amount of interest that most people with IRAs and 401k shell out in unnecessary income tax. So let me show you how you can learn more about this amazing rich man's Roth, which I would recommend is the best way to go. So with current events, President Biden and his major tax plan changes can affect your 401k. You need to be ready. You need to reposition some or all of those contributions to something that's going to be tax-free. So here's how you can empower yourself. I would like to gift you a copy of my most recent 300-page best-selling book, The Laser Fund. These are flying off of the warehouse shelves. This is actually 2 books in one. This one is about 200 pages, 14 chapters with all kinds of charts and graphs for the left brain thinker. If you're a right brain thinker, you learn by stories and examples of metaphors. You flip the book over and you read this one. This one is 12 chapters with 62 chicken soup for the financial soul stories about how the Laser Fund knocks the socks off of an IRA or 401k, but you can use it not only for retirement, but college funding, emergency funds, working capital for business, real estate management, on and on and on. You simply go to laserfund, laser.com, laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book and fire out a copy to you. Here's to your brighter future.